A market cycle refers to the recurring pattern of stages or phases that financial markets go through over time, characterized by alternating periods of expansion and contraction in asset prices, investor sentiment, and economic activity. Market cycles encompass various stages, including expansion, which are bull markets, peak, contraction, which are bear markets, and trough, and are driven by a combination of economic, financial, and psychological factors. Now, let's dive into a detailed explanation of market cycles. Let's explore the stages of the market cycle, starting with expansion, also known as the bull market. The market cycle typically begins with an expansion phase, characterized by rising asset prices, positive investor sentiment, and economic growth. During bull markets, investor confidence is high, and asset prices tend to appreciate steadily over time. Moving on to the peak. This marks the transition from the expansion phase to the contraction phase of the market cycle. It represents the point of maximum optimism, where asset prices reach their highest levels before entering a period of decline. Next, we have contraction, or the bear market. This phase follows the peak and is characterized by declining asset prices, negative investor sentiment, and economic downturns. Bear markets are often accompanied by increased volatility, selling pressure, and widespread pessimism. Finally, the trough. This represents the lowest point of the market cycle, where asset prices bottom out and investor sentiment reaches its nadir. Troughs typically precede the beginning of a new expansion phase and signal the start of a potential recovery in asset prices and economic conditions. Now let's consider the drivers of market cycles, starting with economic factors. Market cycles are influenced by economic indicators such as GDP growth, unemployment rates, inflation, interest rates, and consumer spending. Economic expansions tend to coincide with bull markets, while economic contractions are associated with bear markets. Next, market sentiment, investor sentiment, and psychology play a significant role in driving market cycles, as fear, greed, optimism, and pessimism influence buying and selling decisions, leading to shifts in market trends and volatility. Moving on to fundamental factors. Market cycles are shaped by fundamental factors, including corporate earnings, valuations, monetary policy, fiscal stimulus, geopolitical events, technological advancements, and demographic trends, which impact asset prices and market dynamics. Lastly, external shocks. External events, such as financial crises, geopolitical conflicts, natural disasters, pandemics, or regulatory changes, can disrupt market cycles and trigger abrupt shifts in investor sentiment and market conditions. Duration and variability. Market cycles vary in duration, with some cycles lasting for several years or even decades, while others may be shorter-lived and more volatile. The timing, amplitude, and duration of market cycles can vary across different asset classes, sectors, regions, and market conditions, reflecting the diversity and complexity of financial markets. While market cycles exhibit recurring patterns and tendencies over time, they are not strictly deterministic or predictable and can be influenced by a multitude of factors and uncertainties. Implications for investors' asset allocation. Investors can adjust their asset allocation and investment strategies based on the stage of the market cycle, allocating more capital to growth-oriented assets during expansion phases and adopting defensive strategies during contraction phases. Risk management. Implementing risk management strategies such as diversification, rebalancing, hedging, and asset class rotation can help investors mitigate the impact of market cycles on their investment portfolios and reduce downside risk. Long-term perspective. Maintaining a long-term investment horizon and focusing on fundamentals, valuation metrics, and quality assets can help investors navigate through market cycles, withstand short-term fluctuations, and capitalize on opportunities for wealth creation and portfolio growth over time. In summary, market cycles are a fundamental aspect of financial markets, reflecting the cyclical nature of economic and investor behavior. Understanding market cycles, their drivers, and implications can help investors make informed decisions, manage risk effectively, and navigate through the ups and downs of market fluctuations to achieve their long-term financial goals.